Okay, so now before we get deep into the details on equity and equity compensation, let's spend last moment of time talking about cash, and specifically let's talk about the situations when cash is better than equity and it's in your best interest to actually be asked to be paid in cash and not negotiate equity packages. And I think those situations are again very important because as in the beginning I talked about bad cases where people lost hundreds of thousands of dollars or millions of dollars worth of equity. They probably didn't think enough about when cash is better and when equity is better. And again, the value and the cost of those decisions not being correct are usually quite substantial. So I distinguish four cases here. There is obviously more, but those four I just want to explicitly spell out because many people fall into those situations. If you have one of those four situations, I guess you need to strongly consider cash-heavy compensation rather than equity-heavy. First one is when you have loans, especially high-interest loans, credit cards, etc. Like it generally is not a good idea to try to increase your risk and go after substantial equity packages until you pay all your loans. And on this one, there is actually not full consensus in corporate finance. For instance, it's widely believed that the companies should carry loans, right? That when you have a loan, your value to the market is higher because you get tax savings, and it's even called Modigliani-Miller theorem that says if you have a loan, you're a more valuable business than if you don't have a loan. And that's why leveraged buyouts in many industries happened, that the companies were actually bought out and then they were leveraged. They got lots of loans, and then like they were sold again at a higher price because again the market believed the company with a loan is a better company than the company without a loan. However, if you look at the new company, the new technology companies, Apple, Google, Facebook, etc., those companies have insane amounts of cash in their bank account, right? Apple has, I think, $100 billion alone, and those companies don't have any debt. So that's, I guess, one way to look at this. Debt is not a good thing. It constrains you, even if it creates value to the market, right? It actually does constrains you. It requires time for you to think about it. You need to pay interest, and it's mentally, basically, it's mentally limiting you. It's just not a good idea to have debt. So until you paid out your debt, you probably should think about doubling down on your cash compensation and taking it easy on the equity side. And then once you've repaid all your debt, then you can go full on the equity. The second situation is when you're genuinely cash constrained. It's very similar to loans, but cash constraint means you already do not have loans, but you still struggle, right, with cash. It's hard for you to pay rent, and again, you don't have enough money to go out and maybe to take some classes that you would like to take. So peace of mind is important, right, and it has its own value. So if there is a way you could increase your cash compensation to give you extra peace of mind, it's always worthwhile doing, because in this case, again, your mind will be peaceful, right? You'll be able to learn faster, you'll be able to grow your value faster, and you'll go after higher both cash and equity compensations going forward. So give yourself peace of mind. Again, do not chase equity. If you're really cash constrained, try to increase your cash compensation to a little bit more comfortable level. The next situation is when the company is very likely to die, right? Let's say you're not cash constrained, you don't have loans, and there is this company which you really want to take equity in. So think about it. In some cases, it can be a great decision, right? So if this company goes public and if this company starts being valued in billions of dollars, then it's a great decision. You're an instantly a millionaire or a billionaire. The life is basically great, right? But if you think about the reality and in how many cases those companies actually make it, it's not pretty, right? Because every year you have less than 100 technology IPOs. I think last year, 2017 or 16, I think 16, it was almost nuclear winter. There was almost no IPOs, right? An IPO is one reliable way for you to cash out from the company and to make equity in this company valuable. Like valuable means easily transferable, liquid and valuable, right? Easily transferable into cash. And then there is a second vehicle in which companies usually generate cash to their shareholders, acquisition. In a normal year in technology, again, in the United States, there is probably 300 acquisitions plus 100 IPOs. It's way less than 1,000 events. So only people in those thousands each year can reliably cash out, right, and can reliably convert their equity into cash. Everybody else has to wait. And for many people who wait, there's obviously hundreds of thousands and millions of companies in the US. Many of those companies do not survive. So your equity just basically ends up being nothing, right? Because when the company dies, equity is suddenly worth nothing. So think about it and decide for yourself if your company is likely or not likely to die. If it's really likely to die before it can sell itself, then probably it's not a good idea to go equity heavy. You probably should be choosing cash. And then the final situation is that when the company is already so valuable, when the stock options are already expensive to buy, and we will discuss in detail what it means, but stock options are basically an asset and form of equity in the company which doesn't come to you for free, right? It has an exercise price. And when you join the company gives you certain shares and it says, hey, you will need to be, it gives you an option to purchase those shares at a certain price, but when you leave the company, you'll be given a very short window of time, right? To what it's called exercise your stock options, which means you will need to pay the company for every share that it gave you a right to buy, the price that was fair price at the time when you joined the company. And for some companies, when you join them, they are already so expensive, so your package can be so expensive, which is great on the one side, right? So it's great if you cash out, it's going to be a pretty nice package. But the bad thing about it is for you to cash out, you first need to exercise it. And if the company is not public, then you really have to find some cash, some pretty substantial amount of cash to buy those stock options and to actually get equity. So in those situations, again, when the company is very, very expensive, I would take it and I would give it another thought whether you should go equity heavy or not. Maybe you should prefer cash. So let's summarize. So 4 situations which I described in which I strongly suggest you think and actually believe that cash is probably better than equity in those situations is when you have loans, especially high interest loans, especially credit cards, just pay them off. When you're cash constrained, not necessarily have loans, but when you're just cash constrained, think twice about going equity heavy. When the company is very likely to die, think about it as a very early stage startup, or maybe a large company with lots of employees and almost no cash in the bank. So in those situations, it's just a high risk environment. And finally, when the stock options are already priced very high, so when the company is already very valuable, just think about it. It can be a lucrative equity package. It can make you a millionaire. But think about it, if something happens in your life and by the time you need to exercise the stock option package, would you have enough money to be able to actually pay the price? And if not, then again, think about cash. All right, so now let's start talking about stock options and restricted stock units.